It's not charts per se that I hate, it's those charts with the squiggly lines. Those are hard to understand, but the bar charts, those are okay. So most of them are bar charts. I only have a couple of squiggly line charts, but hopefully they'll be mercifully self-evident as to what it is I'm trying to be talking about there. Let me just set the stage for you today. Bottom line up front first, though. The bottom line up front first for what I'm going to be talking about is that we've got some very supportive economic fundamentals, but the thing that's going to weigh on sales activity this year are the tightened mortgage regulations, B20, I'm looking at you. It's going to take a while for households to adjust to tighter mortgage regulations and to slightly higher interest rates, and that's really the bottom line up front first. The good news is that we do have supportive economic fundamentals, and while we're expected to avoid recession globally and in the U.S., with a caveat and a little asterisk on that, which I'll be talking a little bit later, the overwhelming majority is that we're going through a little bit of a soft patch, but things are going to improve in the second half of this year. So without further ado, let's dive into all the charts. Okay, so this here is a chart that I put up from numbers with the Bank of Canada, the most recent monetary policy report, which gives their outlook for the Canadian economy for this year and for next. I put 2020 up there, and this is going to be the only slide with 2020 data up there because, frankly, that's far enough away that the story can change pretty drastically as the year goes on. So I'm not even going to bother with 2020. I'm just going to really focus on this year. Well, to put it in perspective, over the 5-year period from 2013 through 2017, we had growth. We had economic growth that averaged around 2%, just a little bit under. That's in a rounding error. That's why maybe the bars were a little not particularly aligned. And the Bank of Canada thinks that this year we're going to see economic activity of 1.7%. So a slowing down, and that's primarily due to the softening in oil prices that we've seen of late. But they do expect that because of labor shortages, that firms are going to increase their investment, particularly in non-oil producing regions, and that we're going to see an improvement in exports. And for 2020, like I said, as of the second half of this year, I think things are going to start to rebound, and that momentum is going to carry over into 2020 and improve. So that's a good news story. What I've done here is I've averaged the economic forecast from the 5 major charter banks in Canada. And what we're looking at here is, the 5-year period for 2013 through 17 compared to what we saw for economic growth in 2018. Now, 2018 hasn't come in yet. We're still waiting for the fourth quarter. And you'll notice that, the average of those forecasts is a little bit more upbeat than the Bank of Canada, but they also agree that there's going to be a softening in economic growth this year, a little bit more optimistic from the Bank of Canada again. But of course, mileage varies by where you are, and from that standpoint, we're looking at BC leading the pack for economic growth, and also Ontario. They're going to have better economic growth than the national picture, about on par for Manitoba and Quebec, a little weaker for Saskatchewan and Newfoundland, and weaker than the national economic growth figure in the rest of Canada. Let's pivot over to jobs. Well, I put 2017 up here because we had some really substantial ramp up in job growth in 2017. And then we had kind of a flat, there was a bit of a correction. And this is from the Labor Force Survey that Canada produces. And it's notoriously volatile, but it doesn't look all that volatile. But the most important thing to take away here from this chart is that over the first half of last year, kind of flat looking job growth trajectory, and things really improved in the second half of the year. Good news is that we had good momentum going into this year for job growth. There might be a bit of give back, but again, the job growth is expected to continue this year. We'll get into in a second. And of the jobs that were created last year, a little over 80% of them were full-time jobs, and also the unemployment rate hit a 40-year low. And outside, the Bank of Canada, they also produced this business outlook survey, and according to the most recent one that came out just before their most recent monetary policy report, their economic forecast for this year that came out in January, the results of the survey that they took of businesses across Canada is they're facing labor shortages, particularly outside those oil-producing regions. So what are we looking at this year? Well, We had some pretty strong job growth last year, and we're going to have weaker job growth this year nationally. But from the standpoint of how that stacks up to history, it's about on par with what we saw over that 5-year period from 2013 through 2017. Now, the leaders for that, of course, are expected to be BC and Ontario, Canada's two most populous provinces. So that's going to pull up the national picture. And we've got softer job growth, or about on par, in the rest of the provinces. But the good news is it's positive in every province. Again, this is taken from the average of the Charter Bank forecasts. What else? I always like to translate those percentages into actual levels. Ontario, of course, leading the pack. It's responsible for about half of the national employment increase, and about BC and Quebec will be half of what the Ontario growth is, and a little weaker growth everywhere else, of course, because they're less populous. But again, positive. Here's a forecast from the Conference Board of Canada on household after-tax income growth. Apologies to Prince Edward Island, because apparently there is no Prince Edward Island data available. In any event, we're looking at a pickup in after-tax household income growth this year, so that's another very positive fundamental that's supportive for housing activity this year. Now, of course, mileage varies depending on where you are. We're looking at, the most important takeaway here is that we're looking at household income growth in excess of inflation on a national basis, and indeed in many provinces. So BC, Alberta, and Ontario, and Manitoba, better than inflation, and indeed better than the national picture, the national figure in many of those places as well, but positive everywhere. So I'm just going to pivot to interest rates. I've got a picture of the U.S. Federal Reserve Chairman Jerome Powell and his counterpart, Bank of Canada Governor Stephen Poloz. Well, in the autumn of 2018, they were warning, we are going to be raising interest rates to neutral. We've got to get them to neutral. And they were both on the same page of what neutral means. Right now, they're very accommodative, it's very stimulative, and they want to get to a neutral. Shipping in a neutral. And they both agreed at that time that was between 2.5% and 3.5%. Well, what's happened since then is they've walked that back. First, I was at a big conference in January when the Fed chairman was part of the panel. From his opening scripted remarks saying, we're going to let the data guide us as to how fast we raise rates. And indeed, the neutral rate of interest may be somewhere less than 2.5% to 3.5%. And Stephen Poloz, at the most recent monetary policy report and bank rate announcement, same thing. It's almost like they're colluding. Collusion is so hot right now. So let's take a look. Here's the squiggly line chart. So as you can see, of late, interest rates, no surprise, we know they've been rising. Let me just get to the, there we go. So financial markets are of the opinion, and they bet with their money, right? So they bet there's only going to be one hike this year. The Fed has said most recently there's going to be two this year, but the financial markets are betting on only one. And a better one a chance of a cut, actually, late this year or early next year. The Bank of Canada, the financial markets are pricing in two hikes this year. The first no earlier than April, and no chance of a cut. We'll see how that plays out. Now, I said no chance of a recession this year with an asterisk, and here's the asterisk. There's a fellow by the name of David Rosenberg. Anyone ever heard of him here? He's a really smart guy. He's the chief economist for Lusk & Sheff, which is a wealth management firm that you got to have at least $1 million to invest before they take you on as a client. And he's a really smart guy. He's made his life work. He's an accolade of Gary Schiff's, actually, really famous trader. He's of the opinion, he's made famous also in 2006 for calling a recession in 2008, 2009. He's of the opinion that those interest rates that we've seen in the US have already been enough to put us into recession, but it's going to take time before we start to see evidence of that. And his call, based on the linkages between the stock and the bond market, the financial markets, both bonds and stocks, and the real economy, he's of the opinion that the U.S. economy will tip into recession. He's doubled down on this bet. He made it late last year, and he's doubled down ever since. That those interest rate hikes that have been put in place already are enough to tip the U.S. Economy into recession, and the timing for that will be somewhere around July, August. Now, given the lag with which data are published, that means we'll start to see evidence in his mind in around October of this year. But that's a minority opinion, and indeed there's been a lot of press that you've probably read saying it's like, no, all that worry about, oh, we're going to be heading for a recession that was in the news late last year. Everyone's walked that back, saying, no, it's just a soft patch, and we'll get through this. Time will tell. I'm agnostic about it, but whenever the U.S. sneezes, Canada tends to catch a cold, so it's just something to keep in mind. Of course, that's why we've got financial markets betting, as they are right now, better than a 1 in 10 chance that they're going to make a cut late this year or early next year. So here's a chart that I like to put up. It's Nick Nanos is the brains behind the Bloomberg Nanos Consumer Confidence Index. And what they do, there's 4 questions that they ask people, 2 of which are current looking. Are you better off now than you were in the recent past? And 2 of them forward looking. Do you expect things to be better in the near future than they are now? The 2 questions they ask is, do you think the Canadian economy in 6 months' time from now is going to be stronger or weaker or about the same? And then the other one they ask is, do you think prices for homes in your neighborhood are going to be up or down or about the same in 6 months' time? And what he does is he weights those 2 forward-looking questions, the expectations one, and it comes out with the expectations index on that. So the way to interpret this thing is anything above 50, people are super optimistic. And anything below 50, people are becoming more pessimistic. And the farther above 50 you are, the more optimistic you are. The farther below 50 you are, the more pessimistic you become. At 50, the optimists and the pessimists are an equal number, and it's a wash. And what you'll see here is that early last year, around this time, BC and Quebec were the most optimistic. Well, what a difference a year makes, because at the end of the year, BC had fallen into a deeper funk than was even evident in Atlantic Canada, which are, they tend to be pretty downbeat. Of late, it's a 4-week rolling average. The last couple of readings have been, they've picked up off the very bottom, but not substantively. Certainly they're in a deep funk, and anyone in this room who does business in any of the markets in British Columbia knows that there's a funk going on. The Prairies, of course, increasingly downbeat as the year went by. Ontario, they're still optimistic, but maybe a little less so than at the beginning of last year. But still, positive territory in Quebec, of course, is leading the parade in terms of optimism. So, depending on where you are, the consumer psychology, which is so important for the housing industry, it's either working against you or it's working with you. Quebec, it's a good place to be in terms of people being upbeat. Next couple of slides, I'm going to be talking about home buyer intentions. The question is, do you expect to buy, do you anticipate, do you intend to buy a home in the next year? This is a survey that's one of the many questions that's asked as part of a bigger survey. Altus Group runs it. It's part of Financial Institutions Research Monitor. And you have it broken out by those who currently have a mortgage and own a home, and those who don't own a home. So let's talk about the first group first. Well, remember, in the autumn of 2017 when this was taken, it was just before B20 was announced. And autumn of 2018, it's almost a full year since B20, the tighter mortgage regulations came in. But you can see that people in British Columbia, compared to a year ago, notwithstanding the tighter mortgage regulations, they intend to buy a home. A greater percentage intend to buy a home compared to a year ago. As the same goes for Alberta and Ontario and Atlantic Canada, but there was a massive decline in intentions among current homeowners with a mortgage in the combined regions of Manitoba and Saskatchewan. That's only slightly softer in Quebec. Let's take a look at those who are currently renting or living with mom and dad. I like to use this home buyers because it's fair. Big decline in British Columbia, and interestingly enough, a big increase in Saskatchewan and Manitoba, that combined region. Again, improvement in Quebec, but a real decline in the Atlantic region. So it really depends on where you are. And again, Alberta facing some headwinds that way. So before I finish up with the forecast that Priya published in December about sales activity and average price this year, let me just touch a little bit about Canadian household debt, because that's so the forefront in policymakers' minds. The reason they're really focusing on mortgage, and this chart that you're going to see up here, this little donut chart, this is outstanding balances of Canadian households. And you can see that more than 2/3 of all Canadian household debt is tied up in their mortgage, and that's why they're focused on that, because it has such a heavy weight in the debt load. As far as the rest of it goes, lines of credit make up almost 20%, and it's split almost 50-50, 10%, I should say, between personal loans and credit card loans. So that's why they're really focusing on mortgages. Now with B20, the whole idea was to slow the growth of mortgage credit and improve credit quality, and it's been successful in doing that. But it's still rising, just far more slowly. Credit card debt is actually the one that's rising fastest. But as you can see, it makes up such a small portion of the total debt load that's policymakers are less taken with that than they are with mortgages. That's the reason why. So let me just talk about the debt servicing ratio. What do I mean by that? That's the percentage of your income that goes to service your mortgage payment, or if it was mortgage payment and other consumer credit. Both of those things are still rising, because what's happening is as interest rates have been rising, debt servicing ratio has been rising. And that has obvious implications for the Canadian economy, because the less money you have in your budget after paying your debt, the less money you have for discretionary purchases. So that weighs on economic growth. So I'm going to finish up here with the forecast. So what we saw is an 11% decline in sales activity this year, and we anticipate, we're forecasting that this year, and the reason it was down by as much as it was is that Ontario and BC were looking at you. You're the ones who really weighed down the national result. Less so in other provinces, but you had increases in Quebec, New Brunswick, and Nova Scotia, of course. And this year, we're looking at a further decline of 0.5%. But again, it's going to be British Columbia that we anticipate, because of B20 and the relative unaffordability of homes there, that are going to weigh on things. You've got positive economic fundamentals, but it's the financials that are being sideswiped by the tight mortgage regulations. Also, looking at further declines in Saskatchewan and Alberta and Newfoundland, the oil-producing regions, because they're facing some tough economic fundamentals as well. In Newfoundland, you've also got a net outflow of people that's going to weigh on housing demand. But Quebec, New Brunswick, they're expected to see increases, and a small increase in Ontario. And that's the small increase in Ontario this year is really a reflection of how sales just plummeted in the first half of last year following the introduction of B20. We don't expect that plummeting of sales to happen again. That plummeting of sales, of course, goes to how people rushed their purchases in late 2017 after the B20 was announced in October of 2017. They rushed all those purchases. That was move up and first-time buyers alike. And that was the expense of sales in the first half of the year. Again, as I said, we don't expect that to replay, and that's why we're expecting an increase in Ontario sales. As for price, well, last year we saw a 4% decline in the national average price, and that was a largely compositional thing, and with fewer sales in Ontario and British Columbia, two of Canada's most active and expensive housing markets. I was liking it to when you calculate the average height of a class of kids. You calculate the average height. Now, excuse the 10 tallest kids. To calculate the average height again, well, the average height shrinks, but none of the kids do, and so it goes with average price. You had fewer high price sales, fewer taller kids in the class in British Columbia and Ontario. And nonetheless, even with those fewer sales in Ontario and Quebec, Ontario and British Columbia, we saw a small increase in the average price in BC. But the big price increases last year were in Quebec and New Brunswick. And also PEI put some pretty good numbers up on the board as well. As for the increase this year, again, we're looking at an increase of 1.7%, so a little bit less than inflation on a national basis. But it really depends on where you are. Again, Alberta, Saskatchewan, and Newfoundland, they've got a huge overhang with inventory that's going to take time to work off, and that is, price is always and everywhere an artifact of the balance between supply and demand. And anytime you've got as big an overhang in inventories as you do in those provinces, you can see price declines, and that's why we expect that to happen. Again, in Ontario, because we're not going to see sales, we don't anticipate we're going to see a repeat of that plummeting in the first half of the year. Notwithstanding the fact that momentum, for sales momentum in Ontario weakened as we entered this year throughout the fourth quarter, we don't expect that it's going to reach the depths that we saw late last year. But in other provinces, Ontario, Quebec, and New Brunswick, all going to do better than inflation, and that's about it. I'll wind it up there. We're going to take questions at the very end of both presentations. So my last slide here is moved. We're going to wait for questions at the end. So with that, I'll turn it back. Thanks very much.
Thanks, Gregory. Those were great charts. We're looking forward to more charts. George Ratu leads housing and commercial research at the National Association of Realtors in Washington, D.C. He oversees research programs focused on macroeconomic trends, real estate, and global investments.